Has the Fed changed its tune? Is Bullard right? Is the rest of the Fed kind of coming around to his point of view?
So I think the Federal Reserve has moderated its message by 2 notches. And I think the Federal Reserve has probably moderated its expected policy by a notch as well. I'm not sure that the center of the committee is exactly there with Jim Bullard saying 2.5 will be enough. But is it imaginable that under circumstances of unsettled markets and maybe some risks around investment and some worries about the housing market, that the Fed pauses for a bit, temporarily waits to see how things plays through, and doesn't hike rates in March and waits until June or the second half of the year? Is that a possibility in this environment? Absolutely. And I think that the markets are starting to realize that it is a possibility. And the Fed is communicating its optionality and flexibility more effectively than it had before.
Just 2 other comments from Bullard. First of all, he says that the bond market continues to warn that the Fed policy is too tight. And he also says if the economy unexpectedly weakens, he would be open to rate cuts, which is where the Fed futures kind of got us.
We talked about that yesterday.
So.
That in June, and I was going to just ask Nathan about that. Is the market gone too far? Has Powell expressed too much flexibility in that now the market is betting down the road on a 2020 hike?
I think we need to keep in mind that the core of the U.S. economy still seems pretty strong. And we were reminded of that on Friday by that very strong payroll report. And the consumer's solid, and there will be more fiscal stimulus lifting the economy in 2019.
I just want to turn to you, Jason. Joe and I were talking about saying you're sorry. Okay.
Yeah.
What will it take for the market to say, you know, we were wrong? The economy is really strong. What kind of things would turn the market? Not that the market would say it's sorry, but
yeah. Listen, I think what the market reflected in the last couple weeks of last year, in my opinion, in kind of this order. One is markets are extraordinarily thin. Second, people were quite worried about the Fed making a mistake. I think Chairman Bernanke said last week, you know, business cycles don't die of old age; they get murdered. And there was some sense that the Fed might actually murder this one, is the way it normally happens. And then there's also trade. So I think in many ways, last week, Chairman Powell almost read off a wish list of the things that equity investors wanted to see, which was flexibility on the balance sheet, flexibility as far as the data coming in, as far as future Fed tightening is concerned. One other thing I would just mention with regard to what you said before, I don't know how you feel about this, but I am extremely skeptical that the ECB and the Bank of Japan are going to make any sort of meaningful attempts to tighten. Mainly because I just don't think they have the flexibility to do that. I know they would like to do that, but given what's happening in the economic data, particularly in Europe, I think there's a limit to how much the Fed can really go off the reservation as far as the world's other central banks without causing a lot of financial market instability.
I broadly agree with that. I don't think there's any hint of meaningful tightening of policy in Japan. Maybe a slower pace of purchases, but they're going to continue to be stimulative. And I think the Europeans are going to need to see a stabilization in their economic data before they do any more than they've done. Yesterday's industrial production data out of Germany were very, very concerning and raised the possibility of a technical kind of industrial recession possibly happening in Germany.
Just ask a very, very quick question. You're a big believer in the tax cuts, and I followed your reporting, or your research at your group, which has been very strong, I have to say. Is the idea that the economy cannot withstand 3% on the funds rate, and there being continued gains from the tax cuts, do those things work together, or do they work separately?
No, Steve, I would say that the level of what the markets can withstand in terms of rate increases is different than what the economy can withstand. I think the economy has shown that it can withstand higher interest rates. It's just that the financial markets, after 10 years of quantitative easing, those muscles are flabby in terms of the real economy is outperforming the financial markets right now, and I think it took 10 years to get into a situation where you've quintupled the balance sheet. It's unrealistic to try to get the balance sheet down skinnier in a very short amount of time.